we'll be going over worksheet 6-3, Coverdell ESA Taxable Distributions and Basis, which you can find in IRS Publication 970, Tax Benefits for Education. So Coverdell ESAs have largely been replaced by qualified tuition programs, more commonly known as College 529 savings plans or prepaid tuition plans, predominantly because Coverdell ESAs came first under the tax code. So that when 529 plans came out, they were introduced with larger annual contribution limits without reference to any income, like adjusted gross income limitations, and the account owners, usually parents or grandparents, have a little bit more control over the final disposition of the assets within the account. However, lots of taxpayers still have Coverdell ESAs, and they're using them to pay for their kids' education. So we're going to cover how you use this worksheet to determine what is taxable distribution in a given year and what is basis. So a lot of parents, have been saving for 18, 20 plus years into these accounts, and they understand qualified education expenses. As long as my withdrawals are under that, then they're tax-free. All of that is true. The IRS still expects you to keep records of that, but also keeping track of your basis, which is the amount of your original contribution to your account. And the reason is simple. In a perfect scenario, every dime that you save in a college savings account or a Coverdell ESA goes to pay for those qualified education expenses. However, a lot of people may find different avenues to pay for college, such as scholarships or the military. And so those need to be accounted for within the calculation of this form, but then they also may lead to a result where you finish your college education and now you have money left over, and maybe you decide to take that out. Well, you may pay a different tax bill if you've been paying attention to your basis, which is the return of your invested capital, knowing that anytime you get your own money back that you originally invested, that's not taxable. Only the amount that that money has earned over the years would be considered taxable distribution and subject to a penalty. So making sure that you properly calculate your basis could mean the difference of thousands of dollars anyway. And the truth of the matter is, the first time you get your IRS Form 1099-Q, you're probably not thinking about the last time you eventually get one. But every Coverdell ESA, does close out at some point. Every College 529 plan does close out at some point. So the IRS expects every taxpayer to keep track of their taxable distributions and their basis over time. So this is done in 3 parts. In part 1, we calculate what is known as the adjusted qualified education expenses, known as AQEE, and how much of your distribution went to pay for those expenses. So that part 1, you'll do this for each Coverdell ESA. You'll do this only on one worksheet. Then in part 2, you'll actually complete a separate version of this for each account that you have. So if you have 2 children in college, you would be expected to complete part 2 2 times, 1 for each child. And then in part 3 is the summary. This is the total taxable amount that you'll enter on Schedule 1 of your income tax return. So in a right world, where all of your qualified education expenses exceed the amount of your distributions, you'll see a big fat 0 down there. That means that you're not paying any taxes on the money that you've saved for college. You're not paying any penalties, and all is right in the world. So we'll walk through an example where we do this, and then we'll go back and kind of change some numbers and kind of walk through the hypothetical of what might happen. So in part one, this is for all Coverdell ESA accounts, but in this scenario, we'll pretend that we only have one. So really the total is the same as the individual. So in line A, we're going to enter the total qualified education expenses for the given tax year. The most current version of this publication is the 2022 version. It has not been replaced by a future version, although that should be coming out relatively soon. Most of these numbers don't really change from year to year, so we'll kind of walk through any situations that might warrant it. So let's just say that we spent $30,000 on our only child's college costs for the year, and however, we didn't pay all of that money out of pocket. He got $5,000 worth of educational benefits, like a tax-free scholarship. We also were able to find a place, working with an accountant, to enter some qualified higher education expenses that we were able to deduct on Schedule C, because our son works for us and our accountant hypothetically gave us a scenario where we could invest in his education and write some of it off. So this is not specific tax advice. This is not a recommendation for your situation. This is simply a hypothetical. Seek your own tax advice. But our hypothetical and non-existent accountant told us that we could write off up to $3,000. So, and then finally, we decided to put $4,000 onto the tax form that helps us calculate the American Opportunity Tax Credit. And $4,000 being that the American Opportunity Credit is a dollar for dollar credit all the way up to $2,000. So the first $2,000 you pay in a year, that is 100% tax credit. The next $2,000 is 25% tax credit. So a total of $4,000 has to be paid, but you get a credit of $2,500. So any of these expenses that were either tax-free benefits or tax deductions or tax credits, we have to take those out of what actually came out of pocket, because you can't double dip. We can't use Coverdell ESA distributions in a tax-free setting to pay for costs that have already been either deducted elsewhere on our tax return, taken as a credit, or provided by tax-free educational assistance. So we add all of those up and we get $12,000. And then we're going to subtract that amount from $30,000, which is what we paid. So really, out of pocket, no tax subsidy or anything, we paid out of pocket $18,000. So let's imagine that we took $10,000 from our Coverdell ESA. We wrote a check for the remaining $8,000. So now this does not include rollovers or the return of excess contributions. You'll have to dig deeper into Publication 970 for specific guidance on those scenarios. But in a normal scenario, if this number is smaller than this, you would divide line F by line G, and if you get a number bigger than 1, then you round it down to 1.00. So this basically means that all of our qualified education expenses exceeded the amount of our distributions. So right here, by the time you finish part 1, you're going to know for sure whether or not part of your distribution is taxable or whether or not it's completely tax-free. So we know this for a fact. In part 2, we're going to emphasize that. We'll kind of go through the calculation that verifies and proves that, but then we're also going to make some calculations so that we know what our basis is for future withdrawals. Again, in case next year we're short on cash in our bank account and we end up having to take, let's say, $20,000, right? Then in this case, we would end up with some number less than 1, and we would need to be able to calculate how much of that was a taxable distribution and how much of that was a return of our investment. So in this case, we're fine. We're going to go to part 2, and let's just imagine that we put $2,000 into it in the tax year. We also had been putting $2,000 into this account for the past 10 years. So basis is nothing more than how much you've been putting in year after year for as long as you've had your account. This doesn't include any excess contributions. Obviously, this is the amount that you've been allowed. So if the ceiling is $2,000 a year, you've been contributing for 10 years, and then this year is year 11, you should have $22,000 as your basis. Now, your account balance could be $23,000, it could be $100,000, but the $22,000 is your basis. So if you emptied your account today, regardless of how you spent the money, $22,000 of that would be a tax-free return of your principal. So now in line 4, we're going to enter the total distributions. If we had more than one Coverdell ESA, we would have to add up all of these line. We would have more than $10,000. We would have multiple ESAs, so we would put the total amount into line 4. So in line 5, we're going to multiply line 4 by this H amount, which was 1.00. So that's the amount of the adjusted qualified educational expenses that are attributable to this Coverdell ESA. So if, for example, there were $20,000, but only $10,000 came from this account, then we would be separately calculating the amount of adjusted qualified educational expenses for this account, and then we would have to do it again on a different version of part 2 for the other account. So in this example, it's pretty straightforward. We subtract line 5 from line 4 and we get 0. And then let's just imagine that the total value of this ESA at the end of last year was $30,000. So we put that in there. We're going to add lines 4 and 7. We get $40,000. So that's the amount that was in the account and the amount that we distributed before the end of the year. So at some point, the $30,000 at year end plus the $10,000 that came out of the account, that adds up to your $40,000. So this, we're going to divide line 3 by the $40,000 and we get 0.55. And then we're going to multiply this by the amount that was in the distribution line on line 4, which is $10,000. So we get $5,500. This is the amount of the $10,000 distribution that was considered to be basis. The other $4,500 is considered to be earnings. So of this $10,000 distribution, $5,500 is considered a basis or return of your investment. The other $4,500 would be considered earnings on that investment. So in line 12, we're going to divide line 5 by line 4. So the $10,000 divides by $10,000, we get a 1.0. We're going to multiply this $4,500 by the 1. and that gives us our $4,500. So that's the amount of qualified education expenses that is considered to be tax-free. So when you get down to this part, you'll know, like, if this number was 0.9, then that would mean 90% of your qualified, or your distributions was allocated to qualified education expenses, and you would have to multiply that by 0.9, and then you would come up with something like having to do math on the fly. Let's see, I think that's right. So 4150, that would be the tax-free version, and then you would have to subtract this from the 4,500. You would be paying taxes on the $450. Sorry, 4,050. That's a little bit more like it, right? So that would be what would happen. Let's go back to where we had it before. So in this case, it's completely tax-free. We don't have to include any of it in our income, but we do need to subtract the $5,500 from the original $22,000. That was our basis. So that gives us $16,500. That's going to be what we track for next year. And then if we had more than one version of this form, we would add together all of the line 14 amounts, put that total here, and then that would also go on line 8Z of IRS Schedule 1. We would list the type, we would list that it was a Coverdell ESA distribution, and then we would also need to report this on IRS Form 5329, which is the additional tax form, and that would help us calculate the tax penalties. So let's really quickly, let's just say that we had $18,000 of qualified or adjusted qualified expenses, but we had $20,000 of distributions. That means that most of our money should be tax-free, but not all of it. So we're going to divide line F by line G, and we get 90%. So if all of this stayed the same, let's say that all of the money came out of this Coverdell ESA, we multiply the 20,000 by line H, and we would get $18,000. That's the amount of the adjusted qualified educational expenses. We would subtract this from line 4, so we get $2,000. Let's imagine that our account was $30,000 at the beginning of the year. We add the line 4 and line, so now we get, this is actually $50,000 because we ended the year at $30,000, but $20,000 came out at some point. So we have $50,000. We're going to divide the line 3 amount by that $50,000, which means we get a 0.44, I believe. So now we're going to multiply line 4 by line 9. So we get $8,800. That is the amount of basis that's allocated to our distributions. That part is tax-free. So the rest of this is going to be $11,200. We're going to divide line 5 by line 4. We did that. We got 90% here. So we're going to multiply the 11,200 by the 90%, and we're going to get $1,080. That amount is tax-free. the amount that we have to include in income is going to be that amount, the 1120. That's the part that we would then report on Schedule 1. We would also put that on Form 5329. So now we're going to subtract line 10 from line 3. So that is, we get $11,920. That happens to be the basis that we're going to carry over to next year. And then we would enter 1120 here, and that would be the amount that we include on Schedule 1. So that's all we have for this worksheet. We do actually cover quite a few topics. We'll actually link to this from an article that we just wrote on IRS Form 1099-Q, which is the what do I do when I get my first distribution from a Coverdell ESA or College 529 plan, prepaid tuition plan. What do I do with this 1099-Q? I've never done that before. So if you have a Coverdell ESA, you're going to have to come back and work through this worksheet. So we'll put a link to that article in the show notes. We'll put a link to articles and videos that we've created on all of these other tax forms that we've mentioned also in the show notes. So if you want to go in depth in any more of these, you can feel free to check out our articles. You can go to teachmepersonalfinance.com, type in the tax form that you're looking for, and odds are pretty likely that we've written an article about it. You can also go to our YouTube video series and check those out as well. We try to put out content every day. So if you like our articles, subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our YouTube channel. And if you have any questions or comments, or if there's something that you would like to include in an upcoming series, please don't hesitate. Hit me up in the comments section, and I'll do my best to accommodate you. Thank you very much, and have a great day.